In this video, I'm going to go through our GoPro earnings model with a focus on the latest guidance provided in the November 30th press release. So this is where management gave the update on operating expense guidance, and also the fact that the president was going to be leaving the company and the restructuring charges that were associated with that. So I've incorporated that into the model, and I've calibrated the model to meet the consensus estimates. So if you'd like to download the model ahead of the release, run some sensitivity analysis for yourself, it's available on our webpage, gutenbergresearch.com. If you click on the GoPro model and you just click this icon and download. So I'm going to open the model, and it's structured similar to the other companies that we model earnings for. So any of these dark gray columns, those represent the historic actual results. The light gray columns represent future period expectations. The orange cells represent consensus estimates. Purple cells represent management's guidance. And anytime you see a purple cell, you'll see that I've put in the details of that guidance in the comments. And then the blue cells represent our primary estimates. So for GoPro, the way the model works is the income statement is fed by the shipment details. So we don't actually provide shipment estimates for the individual products. So you won't see like the Hero 5 and Karma Grip or Karma Drone in here. You'll just see total number of units shipped. And then we have average revenue per shipment, and we have quarter-over-quarter growth rates in total shipments. So that's how we build the income statement. So if you just multiply your estimates per revenue per unit shipped, so in this case in the December quarter, I've got $250 on average versus $236 in the third quarter of this year. So we multiply that by the total number of units sold, and that gets us to our revenue in the top of the income statement. So you can see that's a simple equation there. So this model is very simple. The reason I don't distribute out the earnings by individual products is management doesn't give that detail in their press release, so really could never get back to an accurate figure there. And then you're just adding a lot of additional complexity without any certainty there, so it doesn't really make sense to do that. And then after that, you just fill out the income statement using some assumptions for operating expense line items. So you can see we've got R&D, sales and marketing, general and administrative expense here, and gross margin. So this is basically completes all the way down to the operating expense line. Below that, we just fill in the rest of the smaller items. We have an effective tax rate and interest and other income as a percentage of revenue. Then in the non-GAAP section, we have a breakout for stock-based compensation for each one of the expense lines. And we do a similar type of breakout for amortization of intangibles. And then we do have a line for restructuring costs. So when we go back to the press release, you'll see they gave some guidance there. And then I have a reconciliation for adjusted EBITDA. So since the company is not profitable, you can't apply a price earnings ratio. And I took out the discounted cash flow valuation because there's just too much variability in earnings over the next couple of years. So I don't think it really makes sense to try to value the company based on a DCF any longer. So what I'm doing instead is a price to EBITDA multiple, and I'm doing it based on 2018 results. So it's basically saying that you have to assume that the company is going to stabilize in order to apply any real valuation metric here. So I have the stabilization occurring by the end of 2018. Management has said that they expect to get to profitability hopefully at some point in 2017. So 2018 shouldn't be a problem. And I also applied a implied price target band, and that's based on 2 standard deviations of the mean monthly returns over the last 12 months. So you can see that this implies that the lower end of our bound should be $8.50 a share, and the upper bound should be $11.50. But again, this is only 2 standard deviations, so this only covers about 95% of the observations over the last 12 months on a monthly basis too. If you look inter-month, this variability would probably be a bit greater. So this just gives you some flavor for what kind of volatility you can expect in shares. So let's go back to the press release, and I'll show you how I calibrated this model. So first of all, for revenue, I just backed into the total consensus estimates by changing the growth in units shipped. So if we take a look at what we saw for September quarter, so in September, the units were already way down. So they only shipped about just over 1 million units. So December should have been much greater. we know that 2,500 Karma drones, which would have had a higher price target than the cameras, were recalled. So this, both the average price per unit and the total units sold are probably not going to look all that great, but they did have the Hero 5, and in December they did release the Karma Grip, so that may have helped things a little bit. Then we have the normal seasonality, so we bring down the total units shipped in March, down 56.5% from the December high. Then in June and September, I have some stabilization, and then I have an increase again in December of 2017. For price, I brought the price down from my previous estimate to $250 per unit, and then I brought it back up in 2017 because I'm basically assuming that they will relaunch the Karma drones some point in the first half of 2017. But I kept prices somewhat stable in the back half. So we'll just see if they give any additional color on the call this week. We can change these price estimates here. And then from there, that gets us to our total revenue line, and then it's just a function of making some assumptions about the operating expense line items. So this is going to be extremely difficult to predict at this point, but I just wanted to get in line with management's guidance. So if we go back to this press release, they announced that full year operating expenses will be $650 million, and that's on a non-GAAP basis, and $735 million on a GAAP basis. So I will actually tweak the GAAP basis results to get back to that 735, but for now the non-GAAP is in line. Let me scroll up here. So you can see it's in line with management's estimates at 650. And since we value the company based on non-GAAP adjusted EBITDA, this is the metric that matters here. And from there, I just wanted to make sure that I was able to calibrate to meet the consensus estimates for the next 12 months. And you can see that I was, in fact, able to get back to management's total operating expense estimate, as well as the EPS estimate for the consensus. And so that's basically saying that the consensus is, in fact, in line with management's guidance at this point. But every time there's a press release, management gives updated guidance, so we'll need to update this model once the release comes out. And if you'd like, you can download this model and plug in your own assumptions and see what the impact is on overall earnings and valuation. So good luck with this one. This is definitely a lot of variability in here, so good luck with the release and good luck with the rest of earnings season.